Sanger, the managing partner at Geosphere Capital Management, is joining us from the sidelines of the Morgan Stanley 19th annual conference. Good morning, Arvind. Good to have you with us. It would be nice if you dropped into our studios now that you are in the city. But how does it feel? Equities crawling higher, steadily higher, comfortable buying?
I think as an overall market, obviously there's a lot of optimism. Our challenge is to find the companies that we like, and there's always good companies in a market as deep as the Indian market with as many sectors to choose from. There are always some companies, but I think the real challenge is balancing liquidity, which is going to drive valuations high, versus growth and finding opportunities. So we're not distressed by the market, but we're certainly challenged in finding good stocks at reasonable valuations.
Arvind, good morning.
But we are
sure. Please.
Good morning.
Yeah. So in the mid caps in particular, Arvind, any themes which you can still back? Because of course at index level, at aggregate level, we are at all-time high valuations, maybe even higher than 2008, at least on price to earnings, maybe not on price to book. But any themes that you're backing in the mid-cap space?
I think one of the things that we're thinking about is that there's going to be probably opportunities as GST rolls out. I think it's going to be a little less smooth for 1 or 2 quarters. So we're keeping an eye on companies that might get hurt in a GST rollout in terms of any near-term challenges. And looking to buy where we think their short-term dislocation could get hurt, but long-term they're winners from the standpoint of more efficiency, more organized sector benefits. So anybody that is in a business where there's a lot of inventory in the system, and inventories, the dealers and others might choose to run down, and it could be anything as varied from auto components to some consumer goods. So we think there's going to be some opportunities where the organized sector will benefit on a medium to long-term basis, but there could be some dislocation short-term.
Okay. Arvind, morning. We've had a lot of eminent speakers speak to us from the conferences over the last many days and talk about very aggressive targets on the index. If you had to do some crystal ball gazing and give us your view on where the Nifty would be by the end of, say, 2017 or even 2018, what would your prognosis be?
Well, I mean, I think that if we were to look at it, over the next 12 to 18 months, I would say that there's no reason that the Nifty couldn't be, crossing 11,000 in that period. So I think that that's certainly a very reasonable target, given that we see earnings growth of 15+% in FY18, and hopefully continuing beyond that. And I think one of the good news in India is even though there's an election in 2019, I think investors are much more comfortable that the political uncertainty it looks much less, and therefore, as we look out 12 to 18 months, we feel comfortable making a bet on the Indian market based on economic fundamentals without having to worry too much about the political risks.
Okay, ICRA is alerting us that this Cadila approval is actually quite big. It's the Lialda generic, and what Cadila has got good going for it over the last few months is that it's, first of all, its Moraiya plan got clear, and now, it's starting to get some approvals, and this drug itself is quite big. So that's a stock which is doing well. Arvind, I wanted your thoughts on pharma. We've seen quite a bit of buying for select stocks like Aurobindo, Cadila at lower levels. Is this a space, you are in US, of course, based in US, so you have maybe some more information than most of us in terms of what's happening with the authorities. Any sense of whether, these stocks are good buys now?
Well, pharma is a space that unfortunately we don't have much expertise, and we don't look at US pharma. So we stay away from Indian pharma names for the most part, unless it's a special situation. We're more interested in some of the chemicals companies, which are, plays on CRAMS and what have you, and we've had some success there and in the agrochem, but not in the pharma space.
Okay, then agrochem, what do you like in India, if at all?
Well, I mean, I think, United Phosphorus is a name that we have liked for a long time, but that's a much more global play, and, they've had some challenges near term in terms of concerns about Brazil, but I think, Brazil will be fine. and the currency weakness might hurt them a little bit, but otherwise they'll be fine. But there are other companies in the agrochem and seed space that we're looking at right now, and there's always opportunity in that space to find some up-and-comers that are not as well known. So, that's an area that remains one where India has some competitive advantages. And also the chemical space. Don't underestimate that, a lot of the Chinese companies are exiting because of a variety of regulatory factors. So there are a lot of upcoming chemicals companies that are playing in the CRAM space, a name like Navin Fluorine or something like that. There are players that are emerging that could be big winners because they have some unique technology and they have, competitive landscape changing in their favor.
Okay. Well, Arvind, today is the Monetary Policy Day. The widespread expectation or perception is that the Reserve Bank has space to soften its tone, and the outlier expectation is a cut as well. Will that make a big difference to the market?
I think softening of tone would help. A cut would be, frankly, a surprise. But, global interest rates have come off. If you look at U.S. 10-year rates and what have you, they've all come off because the expectation is maybe that there won't be as aggressive a raising in the U.S. So I think as all of that has happened and as inflation has remained well contained in India, obviously in advance of a monsoon, it's likely that they will set the tone but will not pull the trigger. But I think that provides, one of the sectors we like is the financial sector, but all of the industrial players would benefit from expectation or hope of a more dovish, RBI policy stance going forward.
Okay, in fact, I was coming to that question because the stocks that are really surging now are these NBFCs, the erstwhile brokerages that are now bigger NBFCs. IIFL Holdings is up 12%. Edelweiss has hit a new high, almost approaching the 200 rupee mark. Wealth management is becoming a big business and there's so much growth potential here. Is this a space that you have been looking at as well, Arvind?
Yeah, I guess you mentioned two stocks that we currently own. We definitely like the NBFC space, where there's the housing finance companies, but more importantly, I think what you just said is that with so much money flow coming into the markets, the brokers and the wealth managers and others who benefit from market, I think one of the biggest stories of the Indian market, directly and indirectly that's going to drive it, is more and more liquidity flow into stocks as an asset class. And I think that's clearly something that is a trend that we think has legs, that is secular in nature. And again, there'll be dips along the way if the market corrects. But if you take a 5 to 10 year view, I think that there's going to be a lot more growth in Indian financial sector. And therefore, in the past it used to be ULIPs that used to be the preferred option before you've seen the massive change in mutual fund flows and asset flows in general. So I think, yes, the financial space will be a big beneficiary.
Yes, 3 to 10 baggers, most of these stocks over the last 2 years. So phenomenal move is something that we have seen. But, Arvind, the other space that I wanted to discuss with you was, apart from these NBFCs that have moved, discretionary has had a huge move. Whether you look at the auto stocks, whether you look at stocks like HUL, and
air conditioners,
all these stocks, but trading at, again, very high valuations. Do you think liquidity will continue to chase some of these outperformers?
Well, that remains the challenge, which is why finding companies that are a little bit off the beaten path is our hope, because the problem now becomes one of the valuations are so high that if you do any analysis, the amount of compound growth they'll have to do in many of these sectors for 5+ years is 20+% to justify current valuations. And while that's doable, it's not a slam dunk. And therefore, I think the good news is not undiscovered. Okay. So the stocks are well into and ahead of fundamentals. So the challenge is the fundamentals are good, but the liquidity is even better. So trying to find companies, and certainly some of the stocks that you mentioned are way ahead of valuations for our comfort right now. And so we're looking for areas where we can find a little more value.
Well, just to revisit that NBFC argument again, yesterday at the Morgan Stanley conference, Arvind, their analyst was saying how much private sector has gained terrain and how much public sector has ceded terrain in financials. Counting both the public sector NBFCs, you know, like the PFC variety, and the banks, their share is now only 54%. It used to be close to 70% a few years back. So, you know, therefore, do the NBFCs have this, you know, increased area to play?
Absolutely. I think that, you know, clearly, even from the government standpoint, while I don't think the government is willing to or wants to tackle public sector unions in the banking sector and do wholesale shutdown or even mergers, I think that's, you know, going a little slower than certainly I'm sure that they would have wanted, or, you know, investors would have wanted. But the preferred option is to let all the growth happen in the private sector, and therefore I think there's an enormous opportunity. You have very few sectors where you have a completely inept and incompetent public sector, which is what most of the PSU banks are, whether by choice or by design, because of all the problems they have with their, you know, with their NPAs, and still owning significant market share. I wasn't aware that it had come down to 54%, but, you know, that's fast receding. So therefore, in a period of even tepid loan growth, the NBFCs are able to make loan growth of 20+%. Imagine what is going to happen when the private sector loan demand recovers, which it will. And therefore, I think the room for, you know, continued growth for a long time in the NBFC space. And that's why that's an area where we feel comfortable, even though valuations are not cheap, that there's room for growth from, you know, two factors. One is market share, and the other is as yet dormant corporate cycle. So far, it's been a retail cycle, consumer cycle.
Okay, yes, a lot of consumption stocks are moving up. But before we run out of time, Arvind, what could the curveball be that could derail this market in the near term? And even if we do see any kind of downside, do you think it could be just a shallow correction?
Well, I mean, I think curveballs by their nature are somewhat unpredictable, and calling it shallow or deep, I think, will depend on the nature of the curveball. If the nature of a curveball is you know, an economic dislocation or a political surprise in one of the developed economies, then I think it's going to be relatively short-term funds flow, liquidity flow. If there is anything more fundamental that drives growth downside, and I don't think, you know, a somewhat, let's say, a disappointing monsoon, if that were to happen, is going to cause more than a modest correction in the Indian market. So I think any major political event that causes our current confidence that, you know, growth is on a strong trajectory and politics is not going to be a negative factor, you know, something like that which changes our long-term growth expectation, that would cause a deeper correction. But, you know, right now we don't see anything on the horizon. But you never know.
Oh, yes, you never know. In fact, it'll be interesting to see if the Reserve Bank governor wants to say that he sees irrational exuberance in asset inflation, not in consumer inflation. Anyway, Arvind Sanger, pleasure speaking with you as always. Thank you very much for joining.